Hello and welcome to episode 482 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing?
I'm good, Andy. I'm really buzzing. There's been lots of positive things that we've done this week. One thing I will mention, we've had a number of reviews. We're not going to read them out this week because we've got so much to go on in the show. We'll save them to next week. But we've had some huge success on YouTube this week, which Andy and I obviously are very happy about. So we clicked one part of the podcast last week that was related to pensions, and actually it was the Pension Mirror, and that has gone viral on YouTube and it's been really popular. So that's been great. Thank you for everybody who's engaged with that piece on YouTube, where we were teaching people about how much money they needed for their retirement, how much money they needed in their pension pot. And another thing I'm really happy about is the charitable work we've been doing this week. So one of the things, we've donated to a charity that is local to Money to the Masses and its offices, which actually gifts things to families who are struggling. Some of it is food related, so parcels for Christmas. A charity called Brighter Beginnings, if you want to look it up. And another one is I went into the Renaissance Foundation along with Justin this week to give a presentation about investing. And the reason I mention these things is not in a self-congratulatory kind of way, but also to give the charities a spotlight, but also it inspires the biggest piece on this podcast. That presentation I gave about teaching people how they can change their life and build wealth is going to be a core part of the podcast this week. So while I'm talking about what's on the podcast this week, there's three pieces as normal. There's the piece that's inspired by the work with the Renaissance Foundation about investing. So what I'm doing is trying to teach people about investing, how they can build wealth and actually become a millionaire over the long term. And the next piece was inspired by a conversation I had this week in regard to how to teach people about the stock market, so young people. And it's actually sparked an exercise that I'm going to do with my own daughter to try and teach her a bit about investing, but more importantly about the stock market and the economy. So it's an idea that I think a lot of people will be intrigued by, and actually I want to see what people think about it and what ideas they have. And the final piece on the podcast, I can't seem to do anything without people asking me about mortgage rates, and the mortgage market is in a real state of flux. So I want to give people a bit of an update on what is going on with the mortgage market. It's not great news, unfortunately, and I'm going to explain what's going on and what they should be doing right now if they are coming up to a period where they're going to be remortgaging in the future.
Okay, so let's move on to that first piece of the podcast then, Damien. And you've been out and about this week talking to some young, disadvantaged teenagers who were interested in getting into investing, but they didn't really know how to start. So this piece is all about how people can start pretty much from nothing and build wealth.
Yeah, so I wanted to inspire them. So the Renaissance Foundation is a charity that's based in the City of London, and it helps disadvantaged teenagers. So mostly they are carers. So they may come from a background where they may be parents that have a dependency on a substance, for example. They have very disrupted home lives, and they almost are the forgotten people in their schools. So they are people that maybe aren't being fed, they aren't being able to attend school all that often. So they will create events throughout the year to try and help inspire these young people. And a good example is Lewis Hamilton will often take a group of them to Mercedes and show them around. And in fact, one of the young people has been inspired to start becoming a scientist, effectively, to get into Formula One, and they are going to study at university. And so those sorts of things are incredible, and you can see it really does change lives. And we've started working with the charity this year about money, trying to educate them about personal finances. And they were asked about the next session that they had. What did they want it to be about? And investing was the number one topic. So they wanted me to go in there and give a talk and a Q&A about investing to inspire the young people that they help. So I'm bringing it to the podcast because anybody out there who is new to investing, or you may have young people that you know, these are the things I wish I'd learned when I was young, when I was at school. These are the lessons that I wasn't taught and people still aren't. So hopefully it will inspire people that they too can build wealth and change their lives. So we're going to show a presentation on screen. I'm going to go through if you're watching the YouTube version of the show or on Spotify. So what is investing? Now, investing is where you make your money work for you and not the other way around. So I'm trying to inspire people that there is a transition throughout your life where when you first start in work, you are working, you are being paid for your time and your efforts. There comes a point in most people's lives when they're normally about 40 or 50, where they start to think about they want to stop working, they want to retire. And what happens is they realize they've got to generate an income without actually having to work for it. So that usually means they need to have acquired assets over time to generate income that can effectively look after them into retirement. But no one tells you that. No one tells you that there is this transition from having to work for a living to actually acquiring and owning things to be able to then use that to produce an income so you can live off it into the future. So if you're listening to this podcast, where are you on that journey? Because most people don't realize until it's too late that they haven't started to try and transition to be able to own assets. And that could be anything from property to investing in the stock market. Now, of course, investing does involve risk. The money can go down as well as up. It's one of the caveats you'll see on any kind of investment advert, but you don't see it on things like Bitcoin when you're on social media because it's not a regulated investment. But the same thing is true of Bitcoin. Now, perhaps more importantly, what isn't investing? Now, investing is building an asset for the future. Speculating is trying to win a bet in the market today. That isn't investing. You're not trying to own something if you're just betting on the price movements of something. If you own something, you invest in it, it's got fundamentals, and hopefully it can generate wealth for you over time. Now, the other thing I want to say is that I'm not going to Bitcoin bash because I think that is something that will put people off. Bitcoin is just one thing. It's just one asset class. And there are institutions now that do invest in Bitcoin. So investing doesn't begin and end with Bitcoin. Crypto is just a tiny part of the investing story. In fact, if you compare the market cap of Bitcoin to the stock market, for example, or the bond market, it's a fraction of percent in size compared to those. The point is, it's a bit like looking up at the sky at night and you only focus on the North Star because it's the brightest. That would be Bitcoin, when you've got a whole universe out there to take advantage of. Now, I try to make it interesting for people by bringing examples to life and lessons to be learned. So Isaac Newton famously lost a lot of money on the stock market. And the point is, you don't have to be intelligent to invest. It's not about intelligence. It's more about process. So Isaac Newton famously invested in the South Sea Company. Now, that was back in the early 1700s, and they traded with America. So they were also, unfortunately, involved in the slave trade. But the point of the example is there was a bubble because people were investing in the stock of that particular company. There was a lot of enthusiasm, a fear of missing out. And actually, Newton invested in that company. He did make a decent profit and sold out. But of course, the price of that stock, as that whole FOMO, that fear of missing out, drove it higher, it continued to rise, and he therefore invested back into that particular stock. And then the inevitable happened, the bubble burst, and he lost a lot of money on that investment. And actually, if you look at the amount and you roll it up to today's money, it actually equates to about £4 to £5 million. Now, that is a great example about it's not about intelligence, and it's about controlling your emotions. And that bubble, that rise, we see that all the time within markets, and people therefore pile into things and then they lose their money. It's more about discipline that stops that. It's about controlling risk and controlling your emotions that makes you successful. It's not about intelligence. That is why anybody can be a successful investor. Now, the other message I wanted them to take away is the power of compounding. Now, Einstein famously said compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Now, I wish I'd learnt this at school. I think it would have been probably the most useful lesson for anybody, including me, to learn at school that I could use, because I use it now, but they never taught me about it at school, the power for building wealth. Now, one of the best ways to illustrate this point is to use a chessboard. So an extreme example is if you take a grain of rice and you put it on the first square of a chessboard, and then on the second square, you double that, so you have 2 grains of rice. At each square you move along, you double the amount you had on the previous square. If you keep that process up, by the time you get to the final square on the chessboard, the amount of rice that you would actually have would cover an entire football pitch. But not only that, it would be piled to 36 kilometers high. That is an incredible example of compounding. And the idea is you can use that obviously to a lesser extreme example, but you can use that to build wealth. Think of it as the snowball effect. You get a pile of snow, you put it into a ball and it rolls down the hill and it gets bigger over time. You're earning interest on your interest. Now, the part of the quote where he says, he who doesn't understand compound interest pays it, is because it also works on debt. So when you're charged interest on debt and you don't pay it back quickly enough, the debt pile gets bigger and bigger and bigger. Another key lesson is actually to take advantage of compounding. It's about timing the market rather than timing the market. That was a quote from Warren Buffett, who is arguably the most successful investor of all time. And he knew very well about the importance of the time you are in the market rather than just particularly trying to time it by jumping in and out, despite the fact he's incredibly successful. Now, Warren Buffett is actually 94 years old and he's worth about $140 billion at this point in time. The number is slightly irrelevant. It's just a massive number. That's what you've got to focus on. Now, he is successful. He's great at picking companies to invest in, companies that you might know like Coca-Cola. But one of the things that Warren Buffett has also done is used time and compounding to grow his wealth and those of other people that invest in his company. If you go back, Warren Buffett first invested when he was 10 years old. And that particular share that he bought, if you read the stories, sort of fell in value, then came back. And it didn't make him rich, of course, but it sparked his interest in investing. And then the rest is obviously history. If you want to get another example visually of this, if you look at the stock market, so for example, the S&P 500, and you go back over 100 years, you can see that it's grown over time. There's lots of volatility and ups and downs. So if you're trying to time it, you could have picked the wrong time to be in and out and made a loss. But over time, as economies grow, the stock market will tend to go upwards. If you have a long enough time frame, then the stock market goes, if you look at the chart, from the bottom left to the top right. The other thing is that I want to point out to people is the importance of diversification. So people will sit there and they think about investing in Bitcoin or maybe an individual company. Investing successfully is about managing risk, and diversification is a way of doing that. So to illustrate the point to the young people, I picked a bunch of companies and assets that they know. So there is an example on screen that we've got here, Andy. I want to call you in on this because it's a bit of a game I want you to play. And on screen, I've actually got a list of companies and assets. So the first one is a savings account. I've got Apple, I've got Bitcoin, I've got Tesla, I've got Rolls-Royce, and I've got Snapchat. And the example I've picked is just gone back 3 years from the point that I did the presentation and looked at what would have happened if I'd invested £1,000 3 years ago and how much it would be worth at the point that I made the presentation. So the first one, Andy, I'm going to give you, which is a savings account. If I'd invested £1,000 3 years ago, the value today would be £1,093, and you would have made about a 9% growth rate on that. Now, it's a higher and lower game we're playing. Are you ready?
I'm ready.
If you're ready. Right. Apple. So you've got a phone. You will all know Apple. It's probably one of the most famous companies in the world and actually one of the largest companies in the world. Do you think, Andy, if you'd invested £1,000 3 years ago, it would be worth more than the money you'd put into a savings account?
I think it just stands to reason that Apple being the company they are, I'm going to go higher. It's got to be higher, right? That would certainly be my educated guess.
Yeah. So, Andy, you are a winner. Your money would be worth £1,488. That means you would have got a return of 49%. Now, Bitcoin, which is obviously the one asset that the people I was doing the talk for really know about. Do you think Bitcoin would be higher or lower than the value of the investment into Apple? £1,000 3 years ago in Bitcoin, is it worth more than £1,488?
I would say it's got to be worth more. Everyone's talking about Bitcoin. Everyone wants to be involved with Bitcoin. Well, certainly the people who feel like they've missed out. I'm going to say higher.
Unfortunately, Andy, you're wrong on this example. It's in profit. You'd have been up £192. That's 19% profit. But it is actually, your investment would have been worth less than if you'd invested in Apple. It goes to illustrate my point earlier on. There is more to investing than just looking at things like Bitcoin. Now, Tesla. So Elon Musk is now the wealthiest man in the world. He's obviously the CEO of Tesla. Is an investment 3 years ago invested in Tesla £1,000 worth more than Bitcoin? Higher or lower, Andy?
I think this is the easiest one yet, and I'm pretty confident with this one. Tesla's going to the moon, I'm going to say it's got to be higher.
So it's actually, not only is it lower, you would have lost money. Of course, the example I've picked is one time frame. So you've got to remember these share prices and assets are going, except for savings, of course, going up and down. And so depending on what time frame you pick, the numbers would, of course, be different. But just coincidentally, the time frame that I've picked, Tesla shares would actually have lost you over the 3-year period. You would have only have £671. You would be down a third. Rolls-Royce, Andy, the well-known company, Rolls-Royce, would it be higher or lower than the Tesla investment that was made 3 years ago?
I'm going to say it's got to be worth more than the original £1,000. So I'm going to say it's worth more than Tesla maybe, but not much of a gain, I wouldn't have thought.
So you're kind of right and wrong in that one. So £1,000 investment in Rolls-Royce would be worth £4,163 a day. That is obviously an incredible growth rate of 316%. Now, this also illustrates an important point. You need to understand what you own when you invest. Because Rolls-Royce, it's not the cars, because they sold off the car part of the company many years ago. It's now focused on things like aeroplane engines. And so when we had the pandemic and the world returned to going on holiday, there was a greater need for planes. So therefore was great demand for their engines. And also, unfortunately, it's a product of the Ukraine war, because obviously increased defense spending on things like jet planes helped boost their sales and therefore their share price. And the final one we're going to do, Andy, is Snapchat. Obviously, for the people who I'd made this presentation for, the young people, they knew Snapchat. Are we going higher or lower on this one?
It's a complete guess. I would say slightly less. I mean, that 316% is an unbelievable growth. I'm going to say slightly less than that. A small gain.
So this one is actually the worst of the lot. You would have only £238 after the 3-year investment period. Now, of course, when you're investing, you're not investing for 3 years. It's for 5 years or more when you're investing, or hopefully even longer for the long term. But I'm just using this to illustrate the importance of many things like diversification. And one important thing, if you'd invested £1,000, instead of in each of those and just taken a bit of a gamble of which would be the most successful, you'd invested across all of them equally. So £166.66 in each of those. Then at the end of the 3-year period, you'd have £1,474. That's a growth of 47%, which coincidentally is almost the same as somebody who'd invested just in Apple. And they would have been on a wild ride with that one company and the sort of ups and downs and fortunes of that particular company. If you'd invested across all those assets, including cash there, then you aren't exposed to just the fortunes of one company. But in fact, you would have made basically the same as somebody who was pretty much applying all their money into one stock. So that's the importance of diversification illustrated there. But of course, the thing I was pointing out to the young people was you don't just have to own a handful of stocks. You can own the entire stock market. That is why you don't have to have the expertise and the knowledge of individual companies and what might be happening in the world. You can own the entire US stock market, for example, via an S&P 500 tracker, all 500 companies. And if you'd invested £1,000 over that same 3-year period in the S&P 500, it would be worth around about £1,354. So it still would have been one of the most successful investments out of the ones that I picked and gave examples of, even though you invested in over 500 companies. So it's about managing risk, and of course you wouldn't necessarily just invest in stocks. Now, if people are looking at trackers and things like that, they will inevitably come across a company called Vanguard, because they produce lots of low-cost investments, particularly tracker funds. And Jack Bogle is somebody who has been incredibly influential in helping people build wealth. And one of the quotes he's also said is the most important investment decision you make is the first one. Because of everything I've told you, you might be thinking, well, that's all well and good, but how do I do any of this? And the important thing is that it's about engaging and making a decision to take that first step. And that starts with you deciding to perhaps pay yourself first. It's the famous phrase where you decide every month, alongside your bills, that you might put, say, £50 a month to go aside into savings or investments. That first step is incredibly important, because it begins a cycle of you as a person, psychologically, as someone who's trying to build wealth over time. And he also came out with a very good quote. The simplest investment strategy, properly executed, is the most effective. I suppose another way you could say it is the keep it simple, stupid idea. And so rather than trying to be too cute, keeping the process very simple, and it's about patience, time, and commitment. They are going to be the things that are going to help you take advantage of compounding and increase your chances of being a successful investor. Now, anyone who's listened to our podcast will know this phrase, save like a pessimist, invest like an optimist. I covered it on last week's show. I think it's an incredibly important point for anybody, whether they're young or old. You should focus on saving like a pessimist. That means putting money aside, saving for the unknowns out there, but you can also invest like an optimist. So optimism and pessimism aren't mutually exclusive. They can coexist. So perhaps one example of this could be you're putting money into your investments, maybe into your pension, you're saving for your future, but within that structure, you're actually investing with optimism for the long term, and you can invest in all sorts of companies and assets. Now, I promise to show you how you can apply everything I've said, and anybody can do it, no matter where they've come from, what they've got now. They could turn themselves into a millionaire if they take these simple lessons and apply them. And I wish I'd been told this when I was younger, because when you're young, the one thing you really have, the most powerful thing that can help you as an investor is time. You have so much of it, so use it wisely. Now, this example I'm going to run through is if you are 18 years old and you may have nothing at all, no money in an investment account, but you commit to start saving £50 a month and you're going to start investing it. And I've created an example that you might, for example, put it into a tracker fund like I'd mentioned, and you start to invest in the stock market over time. Now, each year you also increase the amount that you put into the investment by the rate of inflation, which on a long-term average is about 3% a year. So the first year you're putting in £50 a month. Next year you put in £51.50 a month. And then the next year after that, you increase it slightly again by the rate of inflation. I've just picked this as an illustrative example. You can increase it by more than that if you want to. If you do that and you stick with that process over the long term, then by the time you reach the current state pension age, which is 68, you would have 1.2 million in your investment account. Now, of course, you've got to take into account of inflation, and that would be worth about £275,000 in today's money. But you are, on paper, so wealthy compared to where you started. So bear in mind, even in this example, if you stick to it, the commitment, and you keep paying that money over time, and even when you get towards that end point, you will only be paying a couple of £100 a month into that pension or that investment. And that will feel relatively low, because you've got to think over time, prices rise and the value of money goes down. So you've got to think that the average salary today is around £33,000 a year, and you compare £50 a month to that number. Well, if you're paying a couple £100 in the future, in say 40 years time, 50 years time, then the average salary isn't going to be anywhere near 33,000. It's going to be many, many multiples more in that relative sense. So this is incredibly powerful, this compounding effect that you can take advantage of. And it doesn't matter where you come from. It doesn't matter what race you are. It doesn't matter about gender. It doesn't matter about what job you do. You can do something you love, your real passion. You can become a YouTuber. You can do whatever you want, but stick to this plan or something very similar and take advantage of these things. Nobody can stop you. And I wish teachers would teach you this at school, to empower people to be better versions of themselves and be able to grow wealth, and importantly, then be able to pass wealth on to the next generation. Donald Trump is not the president of the United States because he's intelligent or because of anything he's done that's particularly great. It's almost exclusively down to the wealth that he inherited. So let's try and change the world, because the wealthy people do unfortunately dictate the world around us. So I wanted to inspire people with this particular piece, and it did inspire the young people at the Renaissance Foundation, which I'm particularly proud of. They're completely enthused about it. So I'd love people's feedback. I want to inspire everybody, not just young people, to show them that how simple investing can be, but also to read more about it, because one famous quote is about one of the best investments you can make is in yourself. So learn about investing, start to educate yourself. And the amazing thing is, when I started doing this 20 years ago, in working in the markets and working in the financial advice sector, nobody could invest unless they had £50,000 and they had a stockbroker who'd actually give them the time of day. Now you can go and buy a coffee, and that change could be put into investments for you. The costs have been driven down. This is now accessible to everybody. So that's why you should take advantage of it. And those who do, and they do it early, can reap huge rewards.
Okay, so let's move on to the next piece then. And it's kind of connected to the last piece because we're talking again about inspiring and engaging people in investing, particularly the stock market. So Damien, you came up with a way in which you can engage the next generation, your family, your daughter, in investing.
Yeah, so this came, like you said, linking to the previous piece, but this came from a conversation I had at that very event. So when I gave that talk, I actually met somebody called Lord Lee, and I'll plead my own ignorance. I didn't know who he was, but obviously he sits in the House of Lords, and he was a former Conservative MP that became a Lib Dem MP. I've learned all of these things. He was a really interesting guy, and we had a conversation about investing because he was there as well, because he is apparently the first ever ISA millionaire. So when you see those stories in the press about ISA millionaires, apparently he was the first ever one. And he's really enthusiastic about trying to engage the younger generation in investing in the stock market. In his case, he's particularly keen about trying to get them to invest in individual stocks and great British companies. And he got us having this conversation about how he's trying to do that. And it inspired me with an exercise that I'm probably going to try with my own daughter. So obviously I talk about the process of investing, how anyone can do it. It's very simple, straightforward. You can invest in diversified portfolios that are provided by companies out there like robo-advisors, like the likes of Vanguard. But actually one drawback is that they don't necessarily understand, I'm talking about young people or people who are new to investing, what's really going on underneath and why their portfolio moves like it does. And for me, that's important because when you see your investments go up and down, it's okay seeing a risk warning, but you need to understand why, because if it goes up and down and you understand why, then you're less likely to make a knee-jerk reaction and bail out of that investment, and you're more likely to stay in it for the long term and benefit from all those things like compounding over time. And he told a story about when his children were younger that he wanted to get them into stock picking. And so he got a portfolio that he picked of stocks, individual stocks, and then he would ring them up every now and then or speak to them and say, look, here's your portfolio, this is how it's going, hoping that they would engage with the individual companies that he'd bought into, maybe like Marks and Spencer's, and how things were going up and down and how it was doing, and try and engage them with it. But unfortunately, he said it didn't really work. They just sort of would turn around and go, oh, wow, that's great, kind of keep up the good work. So he thought he'd try a different approach with his grandchildren. And instead what he's done is he sat down with them and decided to say, right, you go and pick a range of stocks out there and we'll buy them in companies that you know, that you understand. So a good example is something like maybe Hollywood Bowl. It could even be a company like McDonald's or whatever it might be. His focus was on British companies, but there's no reason now extending this why you couldn't do it for any company out there. And the idea was not trying to necessarily pick winners. Of course, they're looking to try and grow wealth over time, but teaching them about what it is companies do and how things work. And if you think about the idea of a company, maybe it might be like Marks and Spencer's. If they buy the shares and they buy a whole range of them, they sit down next year, look at what's gone up and down, and they see Marks and Spencer's has gone up or it's gone down versus other ones, then they try and understand why it's happened and also which ones they're going to maybe keep or which ones they may be going to get rid of. And so those investments he tends to favour are dividend payers, the power of that compounding, using those dividends to buy more shares going forward. And he gave a really good example of one of his grandchildren decided one day to ask him, can we invest in Standard Chartered, which he was quite amazed at. How do you know who they are? And he was like, well, they're the sponsor of Liverpool, his favourite football club. And so they invested in Standard Chartered. But the point is that this exercise really does engage you with understanding why things happen and why markets move the way they do and the fortunes of companies, but also understanding that when you buy a small part of a company, you are buying into the future of that company and those profits, and you're getting your share of those profits via dividends, which when you start to explain that to children, that does blow their mind. And I have to say, most people don't realise that. You buy products and services all the time, but you can actually invest in those companies. And it was a good example, which I can't actually remember now, but if you'd invested in the stocks of Apple every year, if they brought out a new phone rather than buying a phone, how much money you would have. And it's an incredible number. You've probably seen it on Instagram and things like that. But the point is, you understand what you're investing in, which is a key part of investing, but also engages you with economics about what's going on in the economy, what factors influence, for example, if you'd invested in Apple shares or you invested in Tesla, which was a good example when the US presidency occurred and Donald Trump won the election, their share price shot through the roof. And you might be thinking, what happened that day? Even you and I, Andy, have had conversations about shares where you'll go, why is that share suddenly shot up? And we then look into the reasons, and then suddenly there's something happening in the real world. It's more than just the shares. It's about economics. It's about even politics, all sorts of things that really start to engage them. So having learnt that from Lord Lee in that exercise, the world has moved on massively from when he first did it. Because obviously back in the day when he would have done this, you would have had to have a stockbroker and probably sizable sums to start actually investing in shares, because to buy one share of some of these big companies that I've mentioned would actually be quite expensive. But fractional investing and investment platforms and apps that allow you to invest from very small amounts of money mean that anybody could now go and do this, and with a relatively small amount of money buy a tiny stake, part of a share even, a fractional share, to be able to build a portfolio that engages their children, for example, but also even them, so they start to learn. Now, you can, of course, do this as a paper exercise without buying real shares, but you can also on some platforms do dummy accounts. But there is something quite nice about doing small amounts of money to build a portfolio that you sit down with them over time. Maybe every year you review it again. It's that nice element of teaching them about not reviewing their portfolios too regularly, about making changes too regularly, but reviewing them perhaps every year and finding out what's working and what's not, and changing it over time and inspiring them to invest. And it may be they start to realize the power of things like tracker funds, but they also start to understand costs and the importance of keeping them low, because it eats into their profits, which is something else that's particularly important. So I love the idea. It's an exercise that I've mentioned to my 14-year-old daughter that we're going to try, and I'm going to update people in the future. But Andy, I just want to bring you in because you have obviously expertise in doing a lot of the reviews on the Money to the Masses website about platforms that offer fractional investing, for example, because not all of them do. So some ideas here for people. If you want to start this kind of concept, then this is one way of doing it.
Yeah, so that's right. There's lots of apps out there and lots of platforms that do allow fractional investing, but there are lots that don't allow it. So I thought it'd be quite good to just quickly go through an article that we've got on the Money to the Masses website where we list all of those that do and that don't. Also, we give details of the minimum investment needed, and we also give some information about how much it will cost to invest with those particular platforms. So just looking down now on the screen, we've got a list of platforms there. So I'm just going to reel off the ones that do, because for this particular piece of the podcast, that's what we're really interested in. So it's the ones marked in green, as you can see on screen there. So eToro are a platform that allow fractional investing, free trade, interactive brokers, and then we go down further. We've got Moneybox, New Wealth, Plum, Revolut, Robinhood, Trading 212, which I'm sure a lot of people have heard of, and Webull. Now, as Damien mentioned earlier, there are some of these platforms that allow you to use what they call a dummy or a demo account, where you get a fictional amount of money, a virtual account where you can effectively do these trades without having to risk any of your own money. Now, platforms allow you to do this for free, so it's a really good way to get a feel of how these stock prices are moving from day to day. As Damien said, really you should be looking for the longer term, maybe only looking to tweak things once a year. But this virtual account gives you the ability to be able to tweak and test without risking your own money. Now, eToro have a demo account where you get $100,000 to play with, and Trading 212 is another one where you get $50,000 of virtual money and you can just play around and see how you get on. Now, you need to consider also, when you're looking at the stocks and fractional shares, what kind of product you want to put those into. Now, most of these platforms that we mentioned earlier offer a general investment account, but that isn't the most tax efficient way of doing things. I mean, it would be perfect if these platforms allow you to invest in what's called a junior ISA, which is a really tax efficient way for the children to be able to get involved with investing. But that's not a thing at the moment. So consider which product you're going to choose. Obviously, a stocks and shares ISA if you're an adult, There are plenty of platforms that allow you to do fractional investing in there. And of course, if you're an adult investing in this and you want to do it for your retirement, you might want to consider a self-invested personal pension, a SIP. And actually looking at all the platforms that we had on screen earlier, Free Trade is probably going to be the choice in that regard because it's one of the only platforms that allows you to do fractional shares inside a SIP. Now, looking down the list, Robinhood are probably the most cost effective when it comes to the fees. If you look at the fees on the right hand side, they're FX fees, they're foreign exchange fees, and that's a fee that gets charged if you invest in overseas shares. It's actually the currency conversion. There's a percentage that the platform will charge and they make money on that. It's especially attractive with Robinhood. However, they don't offer that stocks or shares ISA. They don't offer a SIP because, of course, when you're investing in single stocks, you can make significant gains. Of course, you can make significant losses as well. So it works both ways, but it's worth thinking about the tax implications. Now, looking at those options, sadly, Trading 212, they do also have attractive FX fees. They do have that demo account we talked about earlier, but they don't offer some of the products. For example, they don't have the pension that we talked about. Looking at the other options, Moneybox is a solid starter option for people. They're relatively straightforward app. There is, however, a slight lack of choice with Moneybox. They've only got around 20 individual shares that you can invest in. So take that in mind. If you're looking at the shares universe, they are very, very narrowed. And if you compare that to someone like Free Trade, for example, even just their basic account, you get access to well over 6,000 shares. So that's something worth considering. Free Trade's FX fees can be slightly more expensive, but if you upgrade to the Plus plan, those fees come down. And actually, Free Trade also pay interest on any uninvested cash. There are ways that you can look around this and work out the costs. Have a look around. We'll put a link to that article in the show notes and people can have a look at which platforms may be best for them when considering fractional share investing.
So that's a great roundup. We've got reviews of all of those platforms. We'll put a link to some of them in the notes of this particular show so you can go and read them. And an article where we round up the best trading apps that are out there. The thing about FX fees, of course, you do have to bear those in mind because it's a likelihood if you did something like this that your young person will probably want to invest in companies that are based in the US because they will know those brands. Like Andy mentioned, the ISA is one way of doing it for yourself. You hold on to the investments for them, but you still engage with them, but it also saves on capital gains and income tax. I'd love to hear other people's views on doing something like this or other ideas that they've got. There are plenty of people out there that are doing things where they're engaging their children into investing, because anything that starts to teach them about investing, wealth building, economics, builds into things like politics, the whole world around them, then I think it can only be a good thing.
Okay, so let's move on to the final piece of the podcast then, and we're going to be talking about the mortgage market in general because there's a bit of confusion, Damien. We had the base rate cut last week, which led a lot of people to believe that that would be a good thing for mortgage rates, and yet we're seeing from a lot of lenders that they're not only raising their rates, they're actually pulling a lot of their mortgage deals. So what is going on?
So it is a confusing market for a lot of people, especially if you're reading the headlines. You're thinking that rates will be coming down on mortgages, but in fact, they seem to also be going up. So what's really going on? We've looked into all the details to give you the lowdown on what's actually happening. Now, at the moment, we've seen a lot of fixed rate deals being pulled or rates going up. It started with a bit of a trickle, and in recent days, that has become a bit more of not a flood, but a definite flow of rate hikes and pulls from the market of actual products. So, for example, Virgin Money, Santander and TSB increased their rates earlier this week, and Barclays, NatWest and First Direct followed suit with hikes, and they actually pulled some products in certain circumstances. The real headline is now that you can't get a sub 4% mortgage rate on a fixed deal, whether it's 2-year or 5-year at all in the market, even if you've got a really good loan to value. So let's say you've got a loan to value of 60% or less, then you still can't get a sub 4%. Now, that's a significant change. So I'm going to give you a couple of examples just to illustrate the point. Barclays increased its 60% loan to value 2-year fixed mortgage from 3.96 to 4.3%. That's a really big hike, especially given that we had a rate cut only a week ago. NatWest also increased the equivalent deal from 3.99 to 4.22%, and Santander increased their residential fixed mortgage rates by up to 0.29%. So what's going on? I'm going to show a chart on screen if you're watching the video version of the podcast, but just to describe it, it illustrates the market predictions of where the base rate's going to be over the next 5 years, and it's derived from something called swap rates, which is effectively shows you the rates that banks will lend to each other. All you need to know is it illustrates where the base rate is likely to be based upon their predictions. Now, there's a range of coloured lines on the chart, and each line represents the date when a prediction was made. If you go back to August, then the market was predicting that rates would fall quickly into next year, through next year, and we'd end up at just above about 3% when it comes to the long-term base rate. Then in September, the prediction was that rates would actually fall even more quickly. But there was a significant change that occurred as we moved towards the budget. And after the budget, you can see, if you look at the screen, you can see a green line that is significantly higher than all the other predictions. There's been a big jump in the market's expectation of where the base rate is going to be in the future. So now the market is not predicting the base rate is going to get much below 4% in the long term. In fact, it's going to end up being, so they think, as we make this show, about 3.8% in 5 years' time. The message is that we're not going to see fixed rate deals fall all that much if you think that they are currently around the 4% level. Now, these predictions do change significantly. I mean, you've got to just look at the chart and the numbers I've mentioned, that they've changed significantly in recent months. The budget had a big impact because of the likelihood of increased government spending that has inflationary pressures that actually can cause inflation to go up because of the fact that the Bank of England might not be able to cut rates as quickly because inflation goes up because of this increased spending and it starts to feed through in the economy. Then if the base rate, which has a big influence on mortgage rates, stays higher for longer, then so do mortgage rates. The important thing is you need to start to shop around. It means you're going to need to be a little bit more decisive when it comes to making a decision around remortgaging. Now, I'm going to give you a bit of good news because there is some good news, and that's that tracker rates have obviously fallen a bit after the Bank of England base rate cut. So the rates are still above the 2-year fixes, for example. So a 2-year tracker is still above a 2-year fix. We'll put a link in the notes to the best rates that you can get right now. Now, it's incredibly important to go and seek advice when you're getting to the point when you're remortgaging. Now, that's because you could be considering tracker deals, but also fixed deals, but not just remortgaging to another lender, but also product transfer. So staying with your existing lender and moving on to a new product. So on screen, if you're watching this via Spotify or YouTube, we're showing you the timeframes in which you can secure a new mortgage via product transfer with your existing lender. Now, usually the advice is to start shopping around 6 months before your deal is due to end. If you're on a current fixed rate deal, you can lock in early, secure a rate if rates continually going up. In the background, you can lock in a rate early, and then it starts when your old deal comes to an end, when that fixed period ends, so you don't get charged any early repayment charges. You can, of course, stay with your existing lender on a product transfer. Usually you would probably shop around, maybe remortgage, but it does require evidence of your income, your earnings, for example, and also your spending. When you do a product transfer, you don't need any of those checks. It's much simpler. It can be just a case of literally filling out a form or just moving straight across. Now, with product transfers, the date at which you can secure a new deal is often much shorter than 6 months. Now, on screen, we've got a range of lenders, and we tell you what the current advance period is. For example, Lloyds, it's 4 months, NatWest, it's 6 months, Nationwide, 4 months, Santander, 4 months, Barclays, 90 days, HSBC, 180 days, as is Virgin Money, Yorkshire Building Society, it's 120 days, Coventry Building Society, it's 4 months, TSB Bank, it's 3 months. So you can go and speak to your lender, you can secure a new deal. If in the interim, when you secure a new deal, whether it's a product transfer or a remortgage, technically, if rates start to fall, you can switch to a better deal before it completes and you move on to that deal. Of course, if you're remortgaging, then that's a little bit more of an effort. It can mean, if it's not with the same lender you've secured the offer with, it could mean another new application. But it doesn't have to. If your lender that you've secured a deal with, they allow you to move across to a better rate because they're offering that, then great. If a product transfer, it could be a similar thing. They will just offer you a better rate. Now, you can, with a product transfer, secure a new deal And in some instances, you can actually switch on to that new deal. Now, that may be interesting for people who fixed a few years ago, let's just say after the Liz Truss debacle with the mini budget that caused mortgage rates to spike. They might be keen to get onto a new deal, even though they seem elevated because they're still cheaper than what they're paying now. Theoretically, it is possible to move on to a new deal early. The only thing is, if that happens, your lender allows that to occur. If rates start to fall more widely, you can't then switch on to a better deal because you're actually on a new deal. So it's something to bear in mind. So make sure you go get advice. Unfortunately, rates are now proving pretty stubborn and they're starting to rise. We'll have to see what happens going into the new year with Bank of England rate decisions and the economy, and what happens obviously after the budget. But it isn't as positive a market as it was a few months ago. You probably have to be a little bit more decisive. You might be looking at other products like trackers, although given the charts I've shown you, the outlook isn't great for rates falling much further. So seek advice, but also you probably might want to look at product transfers in certain circumstances. And I can tell you a tale of somebody I know. They actually went and got advice, were about to remortgage, looked around, they got a rate from a new lender, a potential lender they could apply for, and they also got one from their existing lender on a product transfer. There wasn't much difference between the two. The product transfer was marginally more expensive a month, but not too much. They decided to go with that product transfer for ease and speed, and also they didn't have to provide all the evidence about their earnings. And they were fortunate that they did, because as they did, rates started to go up and they secured the new deal already. So if they'd gone through the application process with a new lender remortgage, it isn't certain that you get the rate that you applied for, but make sure you seek advice. Your mortgage broker can help you with that. So that's it, Andy. We're done for this week.
We are indeed. So please do get in touch with us in the usual ways if you want to feedback on the show or you have any ideas for future shows. It's Andy@moneytothemasses.com or Damien@moneytothemasses.com. Please do, if you haven't already, if you're listening to this on the audio version, go and check out YouTube. We're putting lots and lots of effort into YouTube at the moment. It'll be lovely if we could have you subscribe to our channel and be part of that journey as well. And of course, follow us in all the other usual places on our socials. And please do rate and review the show in all the usual places. We will be reading out some of those reviews in next week's show. So Damien, I think that is everything done. And all that's left to say is until next time.
Until next time.